In this video, we are going to talk about how Fed Chair Jerome Powell's interest rate hikes triggered a banking collapse that has shaken the financial system and threatened the economy. As you may have saw in our previous videos, two major U.S. banks failed in just 48 hours: Silicon Valley Bank and Signature Bank. These banks serve two of the most dynamic sectors of the economy, tech and crypto. Their collapse has sent shockwaves across the markets, causing losses for investors, depositors, pension funds, startups, and other businesses. How did this happen? And who is responsible? Well, we think there is one person who bears most of the blame: Fed Chair Jerome Powell. Let's start with SVB. SVB was one of America's 20 largest commercial banks, with $209 billion in total assets at the end of last year. It provided financing for almost half of U.S. venture-backed technology and healthcare companies. It was a key player in Silicon Valley, where it competed with bigger-name banks. But SVB made a fatal mistake. It invested billions of dollars into long-term U.S. Treasury bonds when interest rates were at record lows. These bonds are generally considered to be safe investments that pay out in full when they're held to maturity. But they risk losing value if interest rates rise before then. And that's exactly what happened. Fed Chair Powell decided to raise interest rates more than expected in response to recent strong data that showed inflation was higher and more persistent than anticipated. He said he was prepared to raise rates higher and faster if incoming data suggested that faster tightening was warranted. This caused long-term bond yields to spike up sharply, which means bond prices fell drastically. SVB suddenly found itself holding billions of dollars worth of bonds that were worth much less than what it paid for them. This eroded its capital cushion and put it at risk of insolvency. To make matters worse, SVB faced a run on its deposits as customers panicked and withdrew their money en masse. This drained its liquidity and made it unable to meet its obligations. On Friday, March 10th, California regulators closed down SVB and handed it over to the FDIC. Now let's move on to Signature Bank. Signature Bank was another large U.S. bank with $85 billion in total assets at the end of last year. It served mainly high-net-worth individuals and businesses in New York City. It also had a big exposure to the crypto market through its digital banking platform Signet. Signature Bank made a different mistake. It lent too much money to risky crypto-related borrowers without adequate collateral or due diligence. These borrowers included FTX.US, a crypto exchange that was accused of fraud by federal prosecutors for allegedly manipulating prices and laundering money. When Fed Chair Powell raised interest rates more than expected, the crypto market crashed hard as investors sold off their holdings to avoid losses or margin calls. This caused many crypto-related borrowers to default on their loans or go bankrupt. Signature Bank suddenly found itself holding billions of dollars worth of bad debts that were unlikely to be repaid. This also eroded its capital cushion and put it at risk of insolvency. To make matters worse, Signature Bank also faced a run on its deposits as customers panicked and withdrew their money. This drained its liquidity and made it unable to meet its obligations. On Sunday, March 12th, New York regulators closed down Signature Bank and handed it over to the FDIC, although the FDIC insures deposits up to $250,000 per account. Many customers had more than that amount in their accounts at SVB or Signature Bank. They may lose some or all of their excess deposits if the FDIC cannot recover enough money from selling the bank's assets. This could wipe out their savings and hurt their spending power. Many investors held shares or bonds of SVB or Signature Bank either directly or indirectly through mutual funds, pension funds, hedge funds, or other vehicles. They may lose some or all of their investments if the bank's assets are not enough to cover their liabilities. This could wipe out their wealth and hurt their confidence. Many startups and businesses relied on SVB or Signature Bank for financing, banking services, payment processing, or other functions. They may lose access to these services or face higher costs if they have to switch to other providers. This could disrupt their operations and hurt their growth prospects. SVB and Signature Bank were major players in the tech and crypto sectors, providing capital and liquidity to many companies and individuals in these fields. Their collapse could reduce the availability and increase the cost of funding for these sectors, which could slow down innovation and adoption. SVB and Signature Bank were not isolated cases. Many other banks have similar exposures to long-term bonds or crypto-related borrowers. Their collapse could trigger a loss of confidence in these banks, leading to more runs on deposits or sell-offs of shares or bonds. This could create a vicious cycle of bank failures that could threaten the stability of the financial system. The banking collapse could have negative spillover effects for the broader economy. It could reduce credit availability and increase borrowing costs for consumers and businesses. It could also lower consumer confidence and spending power. It could also increase financial stress and uncertainty. All these factors could weigh on economic growth and job creation. So how can we prevent this from happening again? Well, we think there is one person who can make a difference: Fed Chair Jerome Powell. We think he should reverse his hawkish stance on interest rates. He should acknowledge that he made a mistake by raising rates too much or too fast. He should lower rates back to more reasonable levels, or at least pause them until inflation cools down. He should also communicate clearly, transparently, consistently his policy rationale expectations. We think this would help restore confidence in the Fed and in the financial system. It would also help ease inflation pressures. By stabilizing bond yields and boosting economic activity, it would also help support the tech and crypto sectors. By lowering funding costs and encouraging innovation. We hope you enjoyed this video. Please like, share, subscribe, comment below what you think about Powell's role in causing the banking collapse. Thank you for watching. See you next time.